Aleksandar, floor is yours.
Dzień dobry, dobar den. Hello from sunny Sweden. So in this seminar, I'm going to present one of my PhD topics. I recently finished my PhD in economics and recently become an assistant professor. And so this is one of the PhD topics, and I wanted to get feedback from, let's say, specialist audience. And I find Spatial Warsaw as one of the, let's say, interesting centers, very good publications. I said, okay, Aleksandar, maybe you should try your luck there and maybe get some feedback. So you can even see by the how long is the title. That means that it's a PhD work. You know, we are not very inventive when we are PhDs. So I'm free to open to change the title even. So I'll be happy to get any feedback from your side. So let's kick off. What is it about? In general, it is about the housing prices volatility. I'm trying to estimate a model on housing prices volatility to estimate the parameters and trying to see if there is a difference, let's say, in the parameters of volatility between two types of housing, apartments and houses. So which exactly parameters I'm going after? For some of you who doesn't know about this model, which I will explain a little bit more later, I'm speaking about mean reversion. That means that if there is like excessive or mild volatility, with the time it will converge to some long run level. Also, there is a parameter for asymmetry, which captures the effect of volatility when it reacts differently to good and bad news. And also there is another pattern called volatility clustering. High volatility is followed by high volatility. And usually we have, because I'm coming from also from finance side and working before with the finance models in volatility, usually it means in times dimension that, you know, you have one period of high volatility, another one, and then suddenly switch to low, low, low. And in the space dimension, it will look something like this. So there are places which are surrounded. Low volatility is surrounded by also low volatility, and then high volatility is surrounded with high volatility. So what does it makes? How this is? What is the effect of this? So this high mean reversion, that means fast converging to some kind of long-term equilibrium, or maybe, and also autocorrelation in a way. This is autocorrelation if you think about it in the time dimension of spatial autocorrelation. They create prolonged persistence in the housing prices volatility, which means slow decay in both time and spatial dimension. In a way, you can predict the volatility if you know yesterday volatility. So what is the research aim? As I said, I'm proposing using a spatial temporal framework to analyze if these two different segments of housing, houses and apartments, have different features of this, I call it idiosyncratic volatility pattern. So I propose this spatial temporal form of gauge processes, and I'm trying to test it also along with already existing arch processes that are already existing in the literature. What is the implication? With this method, I could estimate the volatility persistence at the lowest micro level, at the transaction level. And it allows dynamic transaction level risk management with that. So with this modeling, I'm trying to fulfill the missing link between spatial temporal models that were using aggregated data. So there was spatial temporal models, but using indices or maybe repeated transactions. So this kind of, let's say, papers are, or models are ARMA plus Garch by Dolde, and dynamic space panel model with Garch by Iju in 2013. And recently there was have shown up spatial models of housing price volatility, spatial arch and spatial Garch, using transaction data, one by Simla in 2014 and Philip in 2018. So in this paper, try to fulfill this link, that means using transaction data. But now we have time dimension. You can see here there is no time dimension with spatial arching arch. A little bit literature of housing prices volatility, like why I was motivated to do this. That even Gatzman and Spiegels were arguing that most of the variability of the housing is local. Then Bryant et al. In 2010, they tried to show that by using transactions instead of indices, real estate indices, it could be avoided, the distortion in estimation and problem of smoothing. Also, Droes and Hassing in 2013 claimed that, yes, you can use aggregate house price indices to measure market risk, but they average away idiosyncratic risk. Also, Thanos et al. In 2016 is arguing that strict spatial specification without using the time is creating overconnected spatial weight matrices, which leads to biases in estimation of spatial autocorrelation models, as argued by Duvel-Legros. So this was like, let's say, starting point. And then I was also, because of my interest is housing as well, like housing and finance and spatial econometrics. I try to relate this article to something applicable. And so I relate the literature focused on housing segmentation, regardless if it's stratified by size, let's say big, small dwellings, quality of dwellings, and value, like expensive or non-expensive dwellings. And there is agreement in this literature that really housing markets are not unique and they're composed of set of submarkets, as argued by Burasa. There are also some empirical facts about that. Duda and Belsky found that prices of high value homes are much more volatile than prices of lower value home. Also, Burasa in 2009 found that more atypical apartments, more variance. And he was claiming the mechanism is that what makes this variance behind the apartments that have larger apartments that have atypical features is that it's about larger inherent heterogeneity between the features of these apartments and longer expected time on the market and reduced liquidity. So starting from there, I try to use this spatial temporal framework and using housing prices. While I was working, I also came across, like in any paradigm, people that think similarly. So when I created this paper first, I came across the paper of Hoyland and Carlsen in 2020. They also started working on this issue, but they applied in hydrology and to sea surface temperatures. So how I try to be different than the others and, to not to lose on originality. So I claim that I'm trying to do estimation on conditional variance using microgeographical level. I also try to make comparison between spatial temporal and spatial models. I also include asymmetric effects to check for that. And also try to explore these parameters of models, but taking in consideration geographical distance. Like I thought it's interesting to see from that perspective. If, let's say, mean reversion of clustering is losing the power after, let's say, some kilometers more, some distance, or maybe it's gaining power. So in short, when it comes to risk focus, in other papers, they were mostly speaking about total risk. That means that you take the house prices itself and calculate the volatility, and then you model. This paper is about idiosyncratic risk, what is not explained in the let's say first model. So it's modeling the residuals of classical, let's say, hedonic model, housing model. Then in most of the papers, let's say they use indices. Here I use transactions. Then the dwelling type, you can see literature either on apartments or either on houses. I'm trying to do from the segmentation point of view. Like I try to compare this. So what are my hypotheses? How I build it? I started from what is in the literature. What are the facts there? So usually houses have more atypical features, and houses that have more atypical features, and that means compared to apartments, they have more land value in their total property value. They should have higher volatility. I'm trying to see if really the constant of long-term volatility is bigger for houses than for apartments. Then we also know that apartments trade more often. They have lower transaction cost and lower construction cost per square meter. So I was expecting that this should make their mean reversion, that whenever there is a shock, that they should come up to the normal trend, to the constant volatility, let's say, in faster time, in shorter time. Then taking from the fact that most of the buyers in Sweden, at least, so I'm using Swedish data, most of the buyers of apartments are first-time buyers because housing prices are quite high in Sweden. So I argue that, and also the literature is arguing that most of the people are either buying houses, very small houses, or either buying apartments recently. And these first-time buyers have, according to the search theory now, have prolonged search time, which drift the realization of transactions and prolong, let's say, their buying, they search more, and slow down the response in a way. So now also there is a long-term effect in a way, which is called memory. So I expect that apartments should have longer memory than houses. And then the final effect is a leverage effect. That means what happens if there is a positive or negative shock, how it affects the volatility. So I expect that negative shock increase volatility. So this is most assumption in finance as well. But also there is another theory that argue that negative shocks decrease volatility. So there is like two effects in a way. Sometimes they neutralize each other, or maybe one dominates the other. But I started from my, let's say, expectations that similar to finance theory, that they should have negative asymmetric responses. And I test this using the data. So what are the models that are used? They're called models of dynamic variance, as I mentioned, first used in finance by Black and Engler. And there are two kinds of processes, arch and Garch process, where the variance is modeled as, let's say, some kind of constant variance, and it has a little bit effect from the previous shock squared, let's say last time period. And then Garch is similar in the structure. It has omega as a constant variance. It has alpha as a mean reversion parameter. That means effect of the shock, last shock. And then there is a gamma, third parameter, which is just autocorrelated variance in a way. And how these terms are called usually, gamma, omega is called long-term constant variance, alpha is shock arch effect, and gamma is memory Garch effect. So with this paper, I tried to do the third one, the memory Garch effect. Usually so far was developed spatial arch model, but also I think spatial temporal arch model was not also tested on some data, let's say. And where this memory effect came from because of slow change in housing volatility to exogenous shocks. There's a claim that nice saying that housing is non-liquid durable asset entailing lumpy and ordinarily irreversible capital commitment, which makes to have slow change in housing volatility. So what I propose, I'm going to explain now the models in the spatial temporal context. As I said, this is a two-step estimation. First, you have some kind of hedonic housing model, and in this case, I test several spatial hedonic models. I'm showing here only spatial autoregressive model. So after, let's say, you estimate this model, you estimate a rho coefficient, autocorrelation coefficient, and you estimate parameters for the independent variables, you get residuals. Then in the second step, these residuals are used to model the conditional variables. So they're squared and then imposed some model on them. So how the spatial arch model looks now, if you can see the form, there is not big difference in the form itself. It's just variance is equal to some, say, constant term, and also alpha shock parameter and some kind of, let's say, squared residuals, but it has a spatial matrix in front of it. And to be different than classical spatial, so why this is spatial temporal, that's why it has this sign above it. That means that at each period of estimation, a different spatial matrix is built and estimated. So that means that I'm taking last month, for example, in this case, transactions, let's say maybe there are 30 transactions last month, so they build their own spatial matrix, and I'm trying to estimate a rho on alpha in this case on using that spatial matrix. So that's spatial arch model. Then if you add the third term, that means if you take the variance from the previous time, so I'm taking the variances at each of the points which happened, at each transaction where it's happened. I'm using the spatial temporal matrix to calculate the weights on this squared on this variance, and I'm estimating the gamma parameter, which is the memory parameter. And then finally, I'm creating a symmetric version of Garch. So this is the third term that we are entering. So it's similar to the arch term you see here, but it takes only in consideration if the residuals are negative. So there is an indicator function here that it's one if residuals are negative. So this is the asymmetric version, and I'm trying to have a separate parameter for the negative, let's say, shocks. But how this spatial, what is the secret ingredient here is the spatial temporal weight matrix. The spatial temporal matrix is similar to Thanos 2006. So it's a Hadamard product of the spatial weight matrix and temporal matrix. How the spatial weight matrix is built? It's distance-based. The weight is just a reciprocal value of the distance between two transactions. And then a little bit, so this is the trick that I was using to what is in my head, how to estimate this model. So usually I'm taking the current and previous transactions in consideration and all the parameters. For example, I'm going to take squared residuals from the previous period and from, let's say, current period. Let's assume that the first period has 3 transactions, the second period has 2 transactions. So you have 1, 2, 3 for the first period, 4 and 5 for the second. So 1, 2, 3 here, 4 and 5. Why I'm doing this? Just for illustration purpose. Then I shortcut the procedure, but just to show you why this is important. So when you stack this vector and then you create spatial matrix on all transactions, so you connect all of them, so you can calculate the distance. I only allowed for transmission of effects from the past to present. So when you multiply this, so that's why there are a lot of zeros here, except in the left lower corner. So what does it mean? That it only allows to have effect from 1 to 3, that means previous transactions on current time, nothing more. So there is no effect on previous, like contemporaneous effect. There is no effect from, let's say, 4 and 5 from the second period to the second period, also contemporaneous effect. And there is no forward-looking, let's say, from 4 and 5 to 1 to 3. So everything is excluded except this one. And then you multiply this vector. Obviously, he will just sum this part here and create some products and create two numbers. And also I'm doing the same for Garch method here. I'm taking now the variances at that point of time. As an initial, I take the average of the constant of all variances. So I can start the iteration. And similarly, I allow only past to affect presence. So then the final model is just that here you can see that he's predicting, only showing the numbers in the next period, using omega, constant variance, plus alpha times this multiplication, plus gamma times this multiplication. Of course, you can skip all this. Let's say I can just directly multiply the first vector with this, but I just did it for purpose, so you can know how this iteration is built. And I continue like that. So that's how the spatial temporal matrices are merging, let's say, irregular number of transactions. If we have 2, 3 before and now 2, it's not a problem, Okay, and then what kind of models? And so now I'm playing with how many parameters I want to have. So these are all possible parameters. As I said, variance omega, alpha is shock, memory is persistence, and then asymmetric is gamma. Usually in the literature, if it's so far it was explored a spatial arch, so it has 2 parameters. Then if you want to make it dynamic, except using spatial temporal matrix, you should have also, let's say, if you want to have memory, if you put memory effect here, you will get spatial temporal Garch. If you add dummies, let's say here, you get asymmetric models that captures the asymmetry. And then I play with different specification. Here I have tested all of them. Okay, and then estimation. I use 2 kind of methods, so I can be sure that because there is no package for this, so I need to do it myself. Although I'm not econometrician, so that's why I wanted to get feedback from specialized audience. So I use maximum likelihood QML and then sequential 2-step GMM estimator. Because if there is nonlinearity, I try to capture to avoid that. There is a link here on GitHub where I present some of the code. It's a not very nice looking code, but it works. And I try to prove and check myself against the SPDEP package, which was used to estimate the spatial arch. And I get the same parameters. So in a way, once I test that this is working, then the only trick was with the spatial matrices, how to integrate in the whole story. And then I backtest the model. I try to see how the performance is done between spatial models and dimensional model from simuli. I use root-mean squared error. So I try to minimize the difference between predicted variance and observed squared residual from the mean equation, average of it. And then also I use a backtest method within a risk management framework suggested by Kupiec and Christopherson. So what I'm doing, I'm estimating spatial hedonic model, and then also I estimate the spatial variance model, spatial temporal variance model, and I'm using from the spatial hedonic for the mean equation, I am using the prices like a point estimate, and then I'm using volatility to get bands up and down, normal distribution. And then I try to predict for each period. I try to predict variance for the next period, because that's the whole point of this paper, that variance is predictable, and try to test if the new shock will go above these bands or within the bands. So if variance is correct, it should be within the bands. So there is an indicator function that tests after that, and it counts how many times it was out of the bands. So this house price was either below the lower bound or above lower bound. So you count, sum the number of deviation, and then there is a binomial distribution and then you test this likelihood ratio test statistics here. How it visually, if you can see how it visually look like, this is the lower band, This is the upper band, so mean is somewhere in between. And then these red dots are the realization. So you see sometimes it misses. So shock was bigger than expected, even outside of this confidence interval in a way. And so this is how I backtest, and I will show the results later on. Number of transactions for apartments, I have bigger sample, 2,854, houses 542, and then I split the apartments in two samples as well. So I also test for big and small apartments. I use small as lower than 60 square meters and bigger than 60 square meters, and test this if this cutoff change, how the results change. They didn't change much. Data spans, that is on a monthly basis from 2012 until 2018. And it is from Bully, one of the biggest platforms for trading, buying and selling the housing, apartments or houses. So this is a data summary, some statistics. I don't know if it's worth to go through them. So just to mention what I'm using here. So I have the price per square meter. I'm using log of it. Then I have maintenance cost. I have XY coordinates, distance to center. I create that variable. We have living area, number of rooms, and dwelling age. The classical model, not very complicated. So I avoid a little bit multicollinearity there. And so let's see the models. First, I estimate linear hedonic model. Then I estimate a spatial autoregressive, spatial error model, and then SARAR model. And in all of them, the first estimation pretty much were, let's say, in the same direction, maybe not the same, having the same magnitude, but in the same direction. So what we can conclude from there is that old and big dwellings with more costly maintenance situated far from the city center should have lower price, as expected. And then apartments which are positioned on higher floors have higher price per square meter. Then the statistics from the estimations. You can see that modern statistics for the linear model are quite significant and strong, indicating that there is maybe some spatial correlation not captured by the model. Then I also did BP test to confirm the presence of heteroscedasticity. And let's say in all the models, say here, there was a heteroscedasticity. And with reference to residuals, and also do LM test to see what happens after the spatial model was introduced. They show no significant residual autocorrelation. Then in the second step, as I said, I took the residual from estimations. I squared them, and I used in estimation an underlying conditional variance. My benchmark model was the one from Simulate 2018, and I call it S-Arch, Spatial Arch model. In this Spatial Arch model, usually uses all the transactions in sample. It doesn't care if it happened before or after. So it doesn't. This model is not interested if there is like time spillover of the effects. And also, what I did, all the models I estimated several geographical distances. So let's speak about the main results now. Constant variance, omega. That means the long-term variance. So what is the intuition here? Like if everything is explained only by this parameter, that means there is no process in a way. But if there is a process, then the other parameters should be significant. That means shock or memory parameters, and then these parameters should have lower magnitude or even sometimes. I mean, it must be there, so it must be significant, but maybe the magnitude will be lower, let's say. And so how the results are presented. So here we have, let's say, kilometers from, let's say, 0 to 40 kilometers. And then we have all apartments, big apartments, houses, and small apartments, and this is the scale. And this is, let's say, between 0 and 0.006. We speak about constant variance, so it shouldn't be very high. So that means that, so if you see here, the houses have the highest constant variance, which increased with the time. The others are pretty much fixed. So this is the first finding, and what is interesting, it is the same finding for both spatial and spatial temporal models. So in the next slide, I show the spatial temporal estimation. So this is omega as well. And now I have three different kind of lines. So that means for I'm using three different models. Here I'm using spatial arch, spatial temporal arch, and spatial temporal gauge. And these are asymmetric models here, asymmetric spatial temporal gauge, arch, and asymmetric spatial model. So I need to be careful. I tested many dimensions, but still you can see that houses has still strongest, even all the models showing, let's say, strongest coefficients for omega. So this was very clear picture that here I don't have a doubt about result. So houses has bigger, let's say, constant variance. Then what about the shock in the short term, called shock response? The hypothesis was that because of lower transaction cost, apartments should have biggest shocks. And this is interesting here because we find opposite results to the spatial model. So let's speak first about spatial model, like benchmark model. We can see here, so these are the houses, and these are big apartments. Sorry. Yeah, these are all apartments, in fact, and these are the other type of apartments, and here are the houses. And you can see that houses has the highest shock response, and which is decreasing. But after 30 or 40 kilometers, the significance was already disappearing. And also shock response for apartments was increasing. Let's say if these are too significant, so it was increasing if you take these 2 points. So what is the stylist fact that we can take, and that shock response increase for the with the geographical distance, and housing has the opposite to our hypothesis. But this was for spatial models. In the spatial temporal models, you can see that maybe yes, they look like let's say bigger, the houses, but they are not significant in a way. So you can see there are two. The different models are giving different coefficients, so they are not. I wouldn't trust in a way. And then we can see for the all apartments or big apartments, different models. You can check in the table behind. They're all significant. So there is like contradiction now. Like one spatial model says housing has short response, and our results. My results show that the apartment has stronger shock response. And then this is a symmetric model. This is delta here. Let's say. Let's go further. But what is the main purpose of this paper was, is there a long memory? Because if there is a long memory as a parameter, that means you should use spatial temporal gauge model. And then we find a strong memory effect for apartments at 10 and 15 kilometers. So this is alpha, this is gamma. So you can see here the magnitude of all apartments is between 0.2 and 0.6, 0.10, 0.6. And then small apartments, let's say 0.1 to 0.6, almost very, very strong parameters. So what we can see is that strong memory effect for apartments and 10 kilometers and 15 kilometers. Memory increases with the increase in geographical distance. They increase. Houses in magnitude show higher shock response, but they're not significant. And they have difference between different models. And also what we can say is that when we use a symmetric model here, non-significant memory coefficients we find. See, they are almost zero. So once we introduce spatial temporal gauge, then asymmetry disappears in a way. Okay, and so if we speak about asymmetry, that means that we can speak about asymmetry only for the spatial model. So I said, okay, let's test that because it was not done. Sorry, it was not done before. So let's go to asymmetry. At how because how the model was built and how the setting was that the indicator function was counting negative shocks. So if that parameter delta is positive, that means the total shock response to negative event is stronger than to positive events. So there is a negative asymmetry. If delta was negative, it means shock to negative events is lower than to positive. So it's called positive asymmetry. In this spatial setting, apartments show significant negative asymmetry. So this is that model, asymmetric spatial arch, and this is delta, that the parameter we're going after. And so these are now not the models, but apartments. It's a little bit different point of view. And we can see that these small apartments especially has very strong delta, which in a way confirm somehow the hypothesis, but only in spatial setting, not in the spatial temporal. In the spatial temporal, neither sector shows asymmetry. And then this is important here to see how this shows positive asymmetry. I mean, they have negative delta, but they're not significant again. So there is a huge heterogeneity in housing. So sometimes the coefficients are not significant. Okay, and then I did the model fit and var. So how, let's say, maybe it's not very visible. I should increase it a little bit. So here are all the models. Here is the value of the parameters. It's root mean squared error. This is, let's say, lower RMC. This is higher. So if it goes more to the right direction, that's bad. If it goes more to left direction, it's good. And then we have all apartments, big apartments, and small apartments. And this is houses here. For houses in all apartments, spatial temporal models have lower RMC. So we can observe that. So where is our benchmark model? So this is the benchmark. So we can see benchmark has higher RMNC than the other models, except for a symmetric spatial model. So, but all temporal models, spatial temporal models, have better fit for housing. Also, all apartments. Let's see. Here is the part for RMNC for the benchmark model. It's pretty much bigger than, a little bit bigger than the others. Only in the segment of big apartments, the benchmark model has a big fit. So here only, RMNC are smaller than the others, let's say. Okay, and in the segment of small apartments, all models have similar fit, let's say. Return back. And then the second test was this with the boundaries, how many times the actual realization of the process are wider than the volatility bands around some point estimate. How you can read this? So because there are two bounds, lower and the blue is the upper bound, I have two estimates, like how many lower bound is bridged and how many times upper bound is bridged. So you can see the benchmark model, like this is, let's say, I should increase maybe the scaling here, p-value for lower bound, and this is p-value for a higher bound. And if you compare this benchmark to other models, let's say spatial gauge at 40 kilometers, spatial gauge and 20 kilometers, so I'm using 40 and 20 here. You can see that in many cases, this benchmark model is breaching the bounds, in a way, underestimating the variance for all apartments. Here is not conclusive for big apartments. The worst model is asymmetric spatial model, so it's not temporal. Then for the houses, you can see that benchmark model at 40 kilometers is very bad. And also asymmetric spatial model for 40 kilometers is also bad. And then also for small apartments, these two models are the worst, which a little bit give a favor and make advantage for the spatial temporal models. So I was a bit fast, honestly. So I'll just try to recap what was done, and then maybe we can have more time for discussion. What we can see from these results, these findings, there is a difference between price volatility patterns between apartments and housing segments. What we can conclude, what is general conclusion, is that apartment segments show positive memory and shock response. So any of these effects from the past spill over into the present are much more noticed for the apartment segment. So it maybe confirm the assumption of maybe spatial temporal persistence in volatility, not just in spatial dimension, at least in this submarket. And from this exercise, let's say statistical exercise that is done. Housing segment shows all the time higher constant volatility, which one can notice that it's always compensated by lower effects in shock response memory and asymmetry. So in a way, like there is no process for house prices. Maybe they're too heterogeneous, or one can argue as well. Also, what was interesting finding from this paper, because I tried to relate everything to different geographical distances, and it takes a lot of estimations. One can see that observed volatility, mean reversion, and long memory increase with the geographical distance. Then the final aspect, asymmetry, which is at the beginning I was very optimistic that I'll find a lot of asymmetry, but it was only observed in spatial context. It was more significant. It shows significance only in the spatial context rather than in the spatial temporal. And from that perspective, from the spatial context perspective, the apartment shows asymmetry in the response shock, negative asymmetry. That means that for negative shock, volatility increases rather than to decrease. So with these results, I may be there to say that maybe spatial temporal models have better goodness of fit and better statistical adequacy. Not in all cases, but in general cases. Should be cautious about conclusions. So why this paper? Where it can help? Where it can fit? So at that time when I was making this, it was pioneer testing application of spatial temporal form of GARCH. I need to check what is the current. Honestly, I need to check what is the current state of affairs. And this model enables to test transmission of shocks for smaller areas using irregular transactions data in a shorter time periods, daily, weekly. So it has some practical applications. Then also results shows that different housing segments have different diffusion price shocks, which might be interesting for, let's say, big real estate companies that has portfolios widespread in geography, and they should maybe understand the different drivers if between apartments and housing. Correctly measured price volatility and risk premiums are important when valuing an object for inclusion on selling or out of putting it in the housing portfolio. Like if somebody is trying to build a portfolio, he should correctly measure the price volatility. Because this GARCH element, if there is a GARCH element, that means that portfolio should be rebalanced more often, and then let's say risk managers should use dynamic hedging strategies in a way. If you omit the spatial temporary GARCH element, that it could underestimate the variance and it could create suboptimal capital allocation. And we saw that when we do the benchmark testing, that if you don't use the GARCH element, if you don't use the spatial temporal model, then and you use spatial model, that means there are much more cases when you're missing the estimation of volatility and of the prices with it. Of course, this is just the one exercise that was done. There are many other ways how to do this. One can use other models to test a spatial error model, SAR model. It can use different kind of specification of the mean equation or the hedonic model itself. I used this data. I could access to this data. Yes, and then with this, I would like to conclude. It is a little bit ahead of the time, but I like to speak, so you can see that I speak a lot and quick. So I'll finish with this.
All right, so you're still not ahead of time, so it's 15:48, but okay. Thank you very, very much for your amazing presentation.